It's April the 21st and this is a flash update on oil. By now you'll have seen those extraordinary moves that we had yesterday in terms of the benchmark US contract. The front month May contract on WTI West Texas Intermediate collapsed in dramatic fashion, trading in negative territory for the first time. In fact, watching it, it was amazing to see it go from 18, which is where it sort of opened, eventually got to 10, as it hit 0 and then accelerated down to around about minus 40. Basically what that means is you are going to have to get people, you're going to have to pay people to take away oil. Now part of this is because of the way a lot of commodity futures are set up. They require physical delivery, which basically means if you're long an oil future and you hold it to expiry, eventually a great big truck with oil on it is going to come to your back door. So if you don't want that to happen, you either sell out of the contract or you roll the contract. Now clearly some people probably didn't realise the enormity of that, or they didn't realise just how fewer facilities there were left in terms of storage. Storage capacity in North America is almost close to full. But also it may have been that some people were happy to play what was a widening spread, expecting that they could roll out of their contracts. But then they found that there was no bid in that front month. And even some people who are probably happy to take delivery having bought it at $20 would have been hit with intraday margin calls as we saw this quite incredible collapse with volatility going up to 400% because of this move. Now, it looked very much like it was a front month issue, an expiry issue, a US storage issue, because when we look at price discovery, we look where the volume of contracts are trading. And yesterday, only 200,000 contracts traded in the May WTI contract. Already 1.4 million traded in June. And although June fell 12% in response to the move in the May contract expiring today, it was not a dramatic move, and in fact it stayed above $20. If we look at Brent, which is the global benchmark traded out of London, that fell 5-6%, but again stayed well in its in strong territory, around about $24, $25. So these two contracts were not showing the stresses. If you look at the front month, you could see a massive stress in the ratio of WTI versus Brent. It went to an extraordinary level. But yesterday, if you looked at the ratio of June Brent versus June WTI, it was well within the margins of the last 10 years. However, roll on today, this has clearly spooked the market because this is not just an expiry story, although that is at the heart of the mechanical moves that we've seen over the last couple of days on that front month. But it's a realization that with such a massive outage of real demand, real economy activity, demand for oil remains very, very weak, despite the cuts by OPEC Plus, which clearly failed at this stage. And unless we get a return to even something semi-normality, which is unlikely with these very, very slow returns to work that are only just starting to appear in one or two countries who are along the curve, it means demand for oil will stay low while supply remains very, very high. And that has now spooked the rest of the market. Not only has capacity been reached on storage on North America, but a lot of the offshore tankers have been bid up, as well as people have been looking for ships on which they can store their oil offshore. These are quite dramatic moves. You can see this in the shape of the curve. The curve is in an extreme contango, which basically means that the front month is significantly below the price of oil maybe 12 months forward. So the front month on Friday would have been 20, 1 year forward it would have been 35, showing that there's this real pressure at the front end. If we'd gone 1 year ago, it would have been the other way around. The front month would have been higher than the back month. So it shows that extreme pressure. But I think what we saw yesterday was this issue around the delivery, the deliverables and the lack of storage impacting specifically the front end, but not really the back end. But today now people realizing the real economy remains in lockdown. The supply of oil is still very much in play and the fundamentals are very much under pressure. And I think this can be applied to the rest of the real economy as well. So when we look at financial assets such as the S&P, which is riding high, this is riding high because of that central bank liquidity. But anywhere where there isn't central bank liquidity, which is freely floating, we are going to find truer price discovery, as we're now finding in the June WTI and in the June Brent contracts, which are showing the extreme pressures that this global economy remains under.